Well, it's the morning after the Federal Reserve meeting, and we've got some new information. Unfortunately, it's not as quick or fast or as great as we would like. The United States Supreme Court is going to hear its initial oral arguments in tariffs on November 5th. Right here it is on the docket. And this could get delayed, but typically after we get oral arguments, it's going to take probably anywhere between 3 to 6 months to actually hear a Supreme Court decision on whether or not tariffs are illegal. So, in other words, even though tariffs are probably illegal, we're probably still stuck with them for at least the next 6 months. See, that's not necessarily bearish. It's less bullish, I'll put it that way. I would hope that tariffs get declared illegal, because then our economy will see rapid deflation because, now we'll be lapping year-over-year inflationary prices from tariffs. That transitory over-time inflation the Fed is worried about will disappear. You'll have year-over-year now negative numbers, disinflation and deflation in categories, and it'll really give the Federal Reserve a license to continue to cut rates. Unfortunately, that decision isn't going to come until, frankly, next summer. So it's going to take some time before we get those tariffs gone. Either way, you know me, I expect tariffs will be gone at some point in the future, either courts declaring them illegal or ultimately we end up getting a new administration that says, you know what, we're not doing this. Now, do you understand this, though? This is a potential downside to this thesis that, the tariff will end up being declared illegal. This is a little reminder, and then we'll talk about the Federal Reserve since it's the morning after here. This is a little reminder of how the Supreme Court votes when it comes to Donald Trump versus Biden. And so if you look really closely at that, you could see that when it comes to voting for Trump, the Republicans tend to vote in favor of what Trump wants 80 to 90% of the time. And the Democratic justices vote in favor of what Biden wants a lot of the time. So in other words, yes, the Supreme Court is very politicized, which does mean there's also the risk that the Supreme Court is just going to say that tariffs are legal. But again, we won't know until next summer. So worst case scenario, we're stuck with what we have. Best case scenario, they declare them illegal and we get some deflation. Now, what's going to matter more is that economically, we just cleared a really big catalyst. We really have no catalyst now until the beginning of October. And this is why in the Meet Kevin membership, I've been talking about, hey, once we clear a catalyst, we should be on a clear path to $600 on the Qs, which is remarkable because even from this morning when I mentioned it, we're up substantially. Well, actually, the $600 target we've had for a few weeks now in the Meet Kevin membership. But this morning, just to give you a little spoiler, and then we'll talk about the Federal Reserve here, to give you a little spoiler in this morning's Alpha report, I said bearish real estate stocks today because of the yield rebound on a neutral Powell, bullish Palantir, bullish Hood, bullish Qs, bearish Tesla on the day. Those were my calls in the Meet Kevin Alpha report this morning. Remember, that's at meetkevin.com. Take a look at this. Qs from Hood from when we mentioned it, way up over 3.5%. Palantir from when we mentioned it, up over 3.5%. The Qs moving up, real estate stocks down, and Tesla down, mostly because Tesla is in no man's land. But beyond this Supreme Court catalyst, we kind of have to look and go, okay, what is there that's actually going to hold this market down right now? Well, not rates, because the broader stock market doesn't really care if yields move higher a little bit. This is very normal. Federal Reserve doesn't want to aggressively cut. So yields move up. 10 years almost at my target of 4.15 for a neutral Powell. We almost ran up to 4.15. We're at 4.126 right now. My expectation is actually that this is supportive of the stock market until we actually get some real bad catalysts. Now, we had the leading index this morning that came out with, their recessionary triggers or sell triggers. But really, the leading index has just been wrong and wrong and wrong for the past 3 years. The leading index registered its largest monthly decline since April of 2025, so Liberation Day. They think that tariffs are going to continue to be a drag on the economy. And you can see the leading index has been in decline for 3 years. On top of that, the leading index is indicating recessionary triggers. But these triggers have been firing in 22, in 23, and again now. So I don't know how reliable this is. And the only thing that's actually propping up the leading index is the S&P 500, more broadly, a little bit credit here. But that's a little circular in nature. It's like the more the S&P 500 goes up, the more bullish the data. But that's ironic because the S&P 500 goes up off of the data that is sort of based on the S&P 500 going up. So it's a circular momentum of bullishness. But the reality is, people are cheering that unemployment claims, have their largest fall since 2020 today. But that's only because we normalized after that crazy spike we got from Texas last week. If you actually look at unemployment claims on a 6-month rolling basis going back to 2022, unemployment claims have basically done nothing. I mean, look at this. Unemployment claims, 218 in the first half on average in 2022. Right now, we're at 227. Who cares? Doesn't mean anything. Now, if you look on a week-over-week basis, of course, you're going to have volatility. Now, look at that volatility. But, once you smooth it out, we're really not much meaningfully higher than we were in 2022. And so this is leading, the economists to actually make the argument, maybe there's a chance the Fed's going to end up having policy that's too loose. All of this, mind you, bullish for stocks. The stock market just wants to avoid a recession. The stock market doesn't really care what rates do. The stock market wants earnings to go up and wants to avoid a recession. And by getting 325 basis point cuts, what Jerome Powell is essentially trying to set up, just like Nick T mentioned in his Fed article this morning, is that, hey, we're trying to set up for an economy that avoids a recession, just like we did in 1995 when we had our prior soft landing. And what did we do in 1995? Well, we ended up with loosening interest rate policy. We never got higher than 63 basis points on the 10-2 yield curve, and we ended up soft landing. Yeah, we had a period of slower economic growth, but then we soft landed after that. So now you've got the 10-2 yield curve sitting at 55 basis points. We're below that 63 high, below that high that we saw in 1995. And really, you've got no catalyst until October. What do you have in October? Again, October 1st, ADP, October 3rd, jobs report. Then we'll get some inflation numbers. And then at the end of October, we'll get another Fed meeting. But unless jobs fall off a cliff, this idea of being modestly bullish on the Qs for a slow kind of slog up to 600, which is what we've been calling for in the Course Member live stream, makes sense. It is entirely reasonable that we can keep chugging along. And there's really nothing that says in the morning after that Powell, should be a lot more bearish and should be rapidly cutting. Now, he was very aggressive yesterday. I was frustrated with him because out of one side of his mouth, he's like, we have serious risk to the downside. But I also get it because when we look at the data, it's like, is it really rolling over? And this is where the economists said something that they haven't said before, which is this idea that net migration could end up going negative. This I thought was really interesting. Some researchers think that net migration this year will be negative. Well, damn. Well, we've talked about the unemployment or the jobs break-even rate being very low now. Jerome Powell talks about that jobs growth is below the break-even rate right now. But nobody really knows, because what if we end up having population shrinkage this year? Nobody wants shrinkage.
Little PP.
Nobody wants shrinkage. But it's possible that if our break-even, like if net migration goes negative, then the break-even rate for employment would actually also go negative. So maybe there really isn't a jobs issue. I don't know. Obviously, we'll be paying attention at the beginning of October. But between now and the next 2 weeks, I just can't be bearish on the market. I think it's slow slog up. No analysis over the last, 12 hours or whatever, or 24 hours almost here since the Fed has made me think otherwise. And we're looking on a daily basis. Where are the red flags in the economy? Waiting and seeing. Of course, the labor market is the biggest risk. Of course, the fact that the top 10% of spenders make up roughly half of all spending in America is an issue. Of course, slightly elevated inflation still contributed to by tariffs is an issue. But if we're waiting for that big moment where, Treasury yields plummet, the stock market sells off, and there's some kind of crisis, the only place you're really going to get it is in jobs data. That's the only thing that's going to move this. So again, October 1st and 3rd, and until then, probably slog it up. I think we're going to hit that $600 Qs target very quickly. And so we'll keep sending the alpha reports, but we're pretty excited about it. So anyway, that's my take on where we sit with the market right now. And it's not bad. I think that's why it, puts me at basically 50-50 on the bear bull scale. I mean, we're buying stocks for, top 10 stocks to buy for the next 10 years. But these are stocks we think will do well, recession or not. Or as I like to say, recession or not, here we come. But, wow. Kind of in a good spot right now. Well, I don't know. So leave me your comments. Let me know what you think in terms of why maybe we're missing something.
So here's a great question from the chat. We've got Hybrid Universe says, I'm curious, do they actually put immigration jobs in the jobs data? How can that be used to adjust for how many jobs we should have? This is a great question. And the answer is the Bureau of Labor Statistics has absolutely no idea if the jobs are immigration-based or not. That's because when the Bureau of Labor Statistics calls businesses, they say, yo, how many employees you got? They don't say, how many Americans you got versus how many people from Mexico you got. They don't ask that. So the Census Bureau, when they ask how many people are in a household, they try to get information on where people are from, but they don't ask if people are legal or illegal. But the Census Bureau will count population growth, and so the delta in population growth. So we'll get net migration from the Census Bureau, which will tell us how much is the population growing or shrinking, typically growing. And then the Bureau of Labor Statistics, they're just calling businesses going, hey, how many people you got working? Or they're calling households going, how many people in your house are working, right? Household survey, payroll survey. So nowhere do these two things get reconciled. Basically, you just have economists that are going, hey, if migration is slowing down, then we would expect to see fewer jobs show up in the jobs report. That's it. So, it's possible, though, that economist argument is covering up what is truly a serious weakening in the labor market. That is the risk factor. That this immigration idea is covering up and masking real underlying issues. And that then leads the Federal Reserve to go, we don't really have to cut that aggressively because things are mostly fine. Things are a little softer than break evens, but, mostly fine. And that's why we had such a neutral Fed yesterday. Could that lead them to make a policy mistake? Of course. But remember, Jerome Powell is of the mindset that if SH9T hits the fan, he'll just cut to zero. So that's why Powell was so neutral yesterday. That's why my base case yesterday in the Alpha report was that Powell's going to be neutral and yields are going to go up to 4.15. That's what I told course members before it happened. That's what I thought the base case was. We didn't get all the way to 4.15, but we got to 4.126, just pretty damn close to 4.15, and we could still settle out over there the next few days. But really, it's a really good question because it's basically economists guessing that if the economy is slowing, or if the population is growing slower, then how many jobs we should be getting would be lower. That argument, though, could mask real weakness. And then, again, this is why I say the two things that you pay attention to are the labor force participation rate. If it goes up, the unemployment rate will skyrocket. Or if layoffs go up, the unemployment rate will skyrocket. Those are the things you really have to pay attention to. So it's tough. It's a tough environment. So somebody's asking, hey, why? Basically, the question is why did yields go down yesterday? Okay, so in the dovish scenario, yields would go down, right? So you have to see, you need, in financial analysis, you need nuance. And it's really, really important. So I'm going to make it very clear. Why did yields initially go down yesterday after the Fed meeting? Let's explain. So yields initially fell yesterday because the statement seemed dovish. My prediction, if Powell dovish, yields down under 4%. If Powell neutral, yields up to 4.15%, right? The statement was dovish. Yields fell under 4%. Powell was neutral. Yields up on Powell, which matters more than the statement. So that's what you have to understand when you look at financial analysis. You have to understand, what are you basing the scenarios on? The scenarios are based on Powell. That's what matters. But you get the statement 30 minutes before Powell comes out. So of course, the market is going to have a reaction function to that statement as a potential tell of what Powell is going to do. Obviously, we got a neutral Powell. So anyway, Antonio's House of Pizza says, Kevin, I want to become a member. I really like your analysis. Oh, well, thank you. Yeah, well, join us over at meetkevin.com. We'd love to have you. You're making me hungry, man. I want some pizza. The one thing that is fair is worrying about that 27-week unemployed number. The 27-week unemployed number usually only rises when you're in a recession. Not at the beginning of a recession. It's not a leading indicator. It's a tell that you're already in a recession. And this is probably just the most bearish thing that we could pull out, in addition to having been inverted on the yield curve, right? So yield curve inversion and the 27 weeks unemployed. This is one of the major reasons why I'm still only 5-ish on the bear bull scale. Like I'm not uber bull here. Valuations are high. Yes, I'm buying. I've got 10 stocks to buy over the next 10 years. But I'm buying very specific stocks for what I think will do well no matter what happens, a recession or not. But this number is bad. So there was a question here in the chat that says, is it true that if you've been out of a job for 6 months or more, they no longer include you in the unemployment number? Yes, that is absolutely true. So you end up showing up in this chart if you're long-term unemployed. You kind of get categorized into your own little bucket. And this chart has been rising consistently. And it is a sign that you are in a recession historically. So yes, this is a lingering red flag. Absolutely.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.